Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey. In the last episode, we covered short selling. Now it's time to step into something most investors see but rarely fully understand. Options. Owning a stock gives you one outcome. Whatever happens to the price, you're along for the ride. Up, down, sideways, you're exposed to all of it. Options exist because investors don't always want the whole ride. Sometimes they just want the upside. Sometimes just protection. Sometimes just income. Options let you separate those pieces and trade them directly. At the simplest level, there's two tools. A call is about upside and a put is about downside. Everything else is just about how you use these two tools. A call option is basically saying you want the upside from here, but you don't want to buy the stock yet. So when you do buy a call, you're saying the stock is going to move much higher and is going to do it before the contract expires. Either you're looking for the stock to spike so you can sell the contract into that move before time starts working against you, or you're looking to exercise and buy 100 shares per contract at a strike price you believe will be a discount to the market. If the stock doesn't move enough, you can lose 100% of what you paid for the call options. Because here's the catch. With options, being right's not enough. You have to be right in time. Every calm day that passes eats away at the value of your contract. A put option is the same idea, just reversed. So when you buy a put, you're thinking the stock's gonna drop and you want to benefit from it. Or you're already a shareholder and you're using it as a protective put, which is insurance against a downside move. You might be looking to sell a put contract into a big downside move before expiration, or hold it and exercise your right to sell 100 shares per contract at the strike price. And if you don't already own those shares, exercising effectively turns into a short position, meaning you now owe those shares and will need to buy them back later. There's a very important layer to this that a lot of new options traders miss. Options aren't priced on what might happen. They're priced on what the market already expects to happen. And you can actually see where a lot of those expectations are sitting. Every option has something called open interest. And open interest shows you the number of open contracts at each strike price. In other words, it shows you where traders are positioned. So when you buy a call or a put, you're stepping into a market where a lot of expectations are already set. You're betting on a move that'll be bigger than what's already priced in, and often bigger than what's already positioned for. And that's exactly why options are so risky. People can be right on direction and still lose money. Now let's flip sides. When you sell options, you're taking the other side of that trade. You're basically thinking nothing extreme is about to happen. And most of the time, that's actually true. Markets usually don't explode in either direction, which is why option sellers collect small amounts of income consistently, but in exchange for occasionally being very wrong. A covered call is one of the cleanest examples where you already own the stock and you're thinking, I like this, but I don't think it's about to rip higher. So you sell a call. Now, if the stock stays below your strike, you get to keep your shares and the premium. But if the stock goes above your strike, you still get to keep the premium, but your shares are sold at that strike price, 100 shares per contract. The mirror image of this is a cash secured put. You don't own the stock yet, but you're thinking, I would buy this, but just at a lower price. So you sell a put, and if the stock stays above the strike, you keep the premium. But if the stock drops below the strike, you buy the stock at that strike price. So you're essentially getting paid to wait for your entry or to buy the stock at the price that you set. Now, there's also strategies that involve both the buy and the sell of a contract. A spread is when you buy one option and sell another at a different strike on the same stock and expiration. That can be with calls or puts. And if you're using calls, you're usually saying, I think this goes up, but only to around here. For example, you buy a call at a $20 strike and sell a call at a $30 strike. Now your payoff is defined. Below $20, the trade expires worthless. Between $20 and $30, you make money as the stock rises. Above $30, your profit is capped. If you use puts, it's the same structure, but flipped. You think the stock goes down, but just to a specific range. For example, if you buy a put at 30 and sell a put at 20, then above 30, the trade expires worthless, but between 30 and 20, you make money as the stock falls. Below 20, your profit is capped. So for spreads, you don't need a huge move, you're just targeting a specific range and structuring the trade around that. A straddle is a completely different setup. You're not picking a direction. You just think something big is going to happen to a stock, but you have no idea how the market is going to react. So you buy a call and a put at the same strike. You win if the stock makes a big move up or down, but if it sits still, you lose. This is a pure bet on volatility. And if you're betting on even more volatility but still have no idea in which direction, a strangle is the same concept but with a higher strike on the call and a lower strike on the put. When you step back, all of these strategies are doing the same thing. They're answering 3 questions: which direction, how big is the move, and how soon does it happen? That's it. But there's also a hidden layer in the background. When people trade options, someone is on the other side, usually a market maker, and those market makers usually hedge their risk. If a lot of traders are buying calls, dealers typically buy stock to offset that exposure, and if traders are buying puts, dealers might sell stock. As prices move, those hedges have to be adjusted. Most of the time you don't notice it, but when positioning gets large, those adjustments can start to influence how the stock itself moves. Once you see it this way, everything starts to line up. At its core, a stock gives you one outcome. Options let you reshape that outcome. They change what you need to be right about. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.